Get your money out now as stock prices are headed much lower. I'm your host, Steve Metre, and thanks for joining me today. And while many investors and money managers are doubling down on their bets that the bottom is in, as you're about to see, stock prices can head much lower. Let's head over to Bank of America, where we pick up today's story with this headline that Wall Street's biggest bear. One down, but two more things must happen before stocks bottom. And with that, we'll head over to the Flow Show from BofA Securities, titled Buy Now, Pay Later. As you heard on the street, that one time you've ever seen this level of pessimism and not made money being contrarian was long Lehman. And what they're implying here is the last time we've seen market sentiment this bad, well, that was around when the Lehman Brothers event was blowing up. And what happened months later? Well, an all-out bear market and financial crisis took stocks to an even lower low than the Lehman bottom. And that's what we're seeing right now. Investors saying it can't get worse. But oh yes, it can. The big flow says everyone's bearish, but no one is sold, and that's the key to today's story. For every $100 of inflow since January 21, just $2 of outflow from tech and $3 from equity, $12 from REITs and $22 from resources, $58 from financials, and $93 from investment-grade high-yield and emerging market credit. Note contrast with the great financial crisis, Euro debt crisis, China deval, COVID crisis low, which we'll look at, and note flow starting to catch up with sentiment, which we'll also look at, and rate cuts are still the big missing ingredient from the big low. And let's take a look at all of these as we start out with inflation causes recession chart. And we have talked about this on the show, is how inflation does lead to recessions. In fact, it is a high probability that it does. In fact, let's take a look at this chart of the consumer price index on a year-over-year rate of change. And what we'll note is that not all instances of high inflation, here's one for example, but you'll notice that here's a point of high inflation recession, another one, and you can see that many times, but not always, there are significant correlations to periods with high inflation and recessions. And the question that you should be asking, that I ask, is why does this happen? Now, we don't have a ton of data because the Fed database doesn't have a lot of wage data that we can go back and look at, but they do have some very interesting data that tells us exactly why high inflation leads to recessions. Let's check out this next chart, because now we're going to overlay the average hourly earnings of all employees less the consumer price index on a percentage change. That's in blue, and we'll go over that in a moment, and against the consumer price index in red. Now, unfortunately, we don't have data from the Fed database prior to roughly 2006. But what you're looking at is that when the blue line is trending along this base black line here, that means wages are generally keeping up with inflation, and that's a good thing. That's what you want to see. But notably here, you see going into the great financial crisis, inflation was rising and wages, inflation-adjusted wages were falling, meaning wages were not keeping up with consumer prices. And look what's happening now. Inflation is up and wages are not keeping up with inflation. And that's how you know you're kind of going to have a recession, because if consumers cannot keep consuming at afford these higher prices, well, all of a sudden you get inventory building, and then as inventories swell and get too big, next thing you know, you get a recession. And that's what we're seeing here, is that consumers cannot afford higher prices. They have no choice but to reject them, and that's what leads to a recession. And it happens, well, every time. Let's go on, because B of A points out that flows are starting to catch up with sentiment. And what are they talking about here is the net percentage of fund managers that are overweight securities. And this is, again, a survey. This is their opinion in the light blue, is they're saying, hey, we are reducing our equity positions, or at least we think we should. That's what sentiment is, that they're thinking that they're not overweight equities. And notably, when they B of A charts that equity flows in dark blue suggest that these fund managers have more selling to do to catch up with their sentiment. Now, we don't have, of course, either of those data points in the Fed database, but we do have some other interesting points that we can look at as a comparable. But before we look at that chart, let's take a look at these flows Because right now, B of A saying the flows are really strong, that people really aren't pulling money out. If we look back at prior events, we see equity flows for every $100 of inflow, you see an X dollars of outflow. And during the great financial crisis, saw $113 of outflow, so more money going out. The Euro debt crisis, $52 of outflow for every 100. The China deval, almost $35 in outflow. How about COVID? $61 in outflow. And what money managers and investors are chasing, those who are doubling down. And even though sentiment is suggesting that's not the case, a lot of people that I've talked to, that is just the opposite, that they are taking bets. We're seeing this with a lot of money managers wanting to do this, and there's a reason why. Because if you think the bottom is in, or you're a money manager and you're hoping the bottom is in, trying to turn this around for your clients, then what are you going to do? You're going to double down, because this is what you're looking at. You're saying, look, if the S&P 500 returns and the 6-month post a low and cumulative equity flows is big, and you can actually generate some big returns. But is the bottom in here with this? Well, the answer is probably not. Now let's take a look at the University of Michigan Consumer Sentiment Survey. We've got that in blue, and we'll overlay the Wilshire 5000 price index, or the total U.S. stock market. And what we'll note is there are periods where the University of Michigan's consumer sentiment hits a low, and it tends to correlate roughly with the low in the stock market. So let's fast forward, and we'll come back to this in a moment. We see consumer sentiment is at some extremely low points, consistent with recessions. In fact, low points in recessions. And what does that mean to equity investors is, look, this can't get worse. But let's go back to the dot-com bubble. What happened? Sentiment rallied up a bit and then came crashing down. And it wasn't until that second crash in sentiment that we get a bottom in the market. How about the great financial crisis? Sentiment rebounded, and that held stocks up for a little bit. And then what happened? It just stayed low. It came crashing back down to the prior levels, and that drug stocks down with it. Here you can see in 2011, sentiment crashing, stocks went down with it. We see the pandemic. And so even if sentiment just stays near this level and just oscillates up and down, it doesn't mean stocks have bottomed yet. It means they could go down a whole lot more. And that's one way we should be looking at this. Now let's take a look at the next thing B of A points out, which is rate cuts are still missing. And they're right. That is a big thing that's missing, but this is something a lot of people don't understand. And right now, their fund manager survey says short-term rates are going up. And with the Fed meeting next week on Wednesday, we'll get a policy announcement where we're largely expecting a 75 basis point hike. We could maybe get even 100 basis points or a full percent. But what it means here is that it's until fund managers believe that the hiking cycle is over, in fact, that we're going into a cutting cycle. Well, look at this. You see the dot-com bubble. 77% of fund managers saw a negative minus 77% of fund managers. So they believed that rates were going down. They said, hey, 77% of fund managers said rates are going to fall. But nope, we see this equity flow. We'll look at this. We see percent of assets under management is really high. So investors are sitting on 62% of their money in equities. And historically, at a bottom, that's closer to the 40 to 50% level. So we've got a ways to go. We'll look at that in a little bit. But let's tackle the short-term rate issue, because this is something that I think a lot of people get wrong. They think, hey, if the Fed just pauses, that's super bullish for equity. If they cut a little bit, it's super bullish for equities. No, not at all. In fact, the Fed's got to cut a lot before you see a bottom in the market. Here we'll take a look at the federal funds rate in blue against the Wilshire 5000 price index. And I want to note that here you can see the market starting to go down. The Fed plateaus, and what? The market keeps falling. The Fed aggressively cuts. Note the market is not going up. It's not until the Fed gets near the bottom of its cuts and then the market bottomed. How with the great financial crisis? Again, the Fed paused, the market paused, and then all of a sudden, boom, rates start getting cut, and the market goes down with it. It's not until the Fed stops cutting, again, that we see the market bottom almost after the fact. You see that during the pandemic, and now everyone believes a simple just pause by the Fed is going to do the trick, and that's not it either. It's going to take the Fed going full bear mode, full cut mode, and dropping rates down to zero, or whoever knows if they can even get it negative if they want, or massive amounts of quantitative easing before we're in a bottom. And do know, when the Fed cuts, stocks can do and have fallen. But it's not just stocks that we need to look at, it's the bond market, because it's telling us we're nowhere near a bottom either. Now, the B of A pulls this chart, which is credit event vulnerabilities, and they're looking at the Euro real estate investment grade bond spread. But we're going to look at something a little bit different, but they're pointing out, they said, look, bond spreads are really high and they have to collapse. And that's right, we need to see a collapse in spreads. But let's look at a different chart. Let's take a look at the 30-year Treasury yield here in blue against the Wilshire 5000, because, again, we need to see rates come down, and substantially and usually to new all-time lows before we see a bottom in the stock market. Whereas right now, everyone thinks, well, if rates just drop a little bit, we'll get there. But look at this. Here we can see during the dot-com bubble, rates actually backed up a bit going into, of course, the recession, and then what happened? They came crashing down. That signified at least an interim low in the market. Little did we know at the time the stock market was going to rally back up with rates, and then they came crashing down again, making what would be another new all-time low. And of course, that corresponded with the bottom of the market. How about the great financial crisis? Rates bottomed ahead of the stock market, if you can believe that. Many people say that's not going to happen. And then, of course, a lagging effect, rates went down again. Of course, later on, 2 years later, they pulled out a full bottom. So you'll notice the stocks so far and yields both need to go down. Looking at the pandemic, you see stocks going down, yields crashing to new all-time lows, suggesting right now that yields actually need to make new all-time lows. And that's real important, because a lot of money managers don't think that. But there's one strategy that gets that, and that's Portfolio Shield. It knows that rates have to bottom out and bond prices have to make new highs in order for this to happen. And that's what makes it special, how it reverses all of its losses and it's done before. I'll put a link up there in the corner and the description below. You can check that out. Now, if you want to deepen your understanding of the bond market, well, I went over and visited Emil Kalinowski and Jeff Snyder on their show, where we talk about the Treasury International Capital Report. And this is how flows moving around the world influence the bond market, or do they? Well, if you want to take your understanding to a new level, I'll put a link up in the corner and description below, and you can go watch their show. I'll encourage you, because Jeff's our chief strategist. There's a reason we're so excited to have him on the team, one of the best thinkers in the world on the monetary system. So if you want to learn more, check him out. Let's continue our story now, because we still haven't seen the bottom, because housing price growth hasn't slowed. Here we can see B of A saying global housing prices don't yet reveal big monetary tightening. What we need to see is home price growth actually get close to zero and maybe even go negative. That would actually help signify that perhaps there is indeed a bottom being set in the stock market. Not happening yet. And here's a chart that I have a bit of issue with, because I don't really care much for how they're suggesting what's going on, that we are seeing price action of 2022 has mirrored stagflationary environment of 74 and 75. And what B of A is trying to suggest is the Dow Jones Industrial Average in dark blue is leading the U.S. federal funds rate, showing inverted, as if the stock market is leading policy rate, in the sense that there's some truth to that. But what happens, I want you to be thinking of this, what happens following a period of stagflation, which is when you have rising unemployment, which we have a little bit of, but not that much, and rising prices? You get deflation. There's almost 100% chance that after stagflation, you get deflation. But really, is this a story of the stock market leading the Fed, or is it perhaps something else leading both of them? And that's what we want to talk about today, is current new orders. We've talked about this in past shows, that new order growth from the Philly Fed, where we have a ton of data on. And we talked about on a previous show, even our chief strategist, Jeff Snyder, points out this is a wonderful leading indicator. And when you overlay the Wilshire 5000 price index on a year-over-year rate of change, what you'll note is that as new orders go down, the stock market follows. And it makes sense, because all the stock market's doing at this point is saying, look, we're looking at future growth. It's seen as going down, and that means stock prices should fall. And then what does that have to do with the CPI? Well, it has to do with a lot, because if we take that same Philly Fed data dip and we overlay the consumer price index, what we find out is the consumer price index is a highly lagging indicator. The new orders go down, and then eventually inflation comes down with it. But back in the 70s, as BofA points out, we see new orders falling, and we see the stagflationary event of the consumer price rising. And lo and behold, what do we have here? New orders falling and CPI rising. But what followed? Well, the CPI growth came reversing into disinflation, and what CPI being so relatively low compared to where it is historically, we're likely to see outright deflation. And let's look at one more thing here, because we've got equity allocation sitting really high at 62% of assets under management. So investors are very overweight stocks when historically they should be closer to 54%, and they're sitting way underneath where they should be in the bond market. Typically, they're around 26%. The peak at February 2009, they were holding 4% of their assets. Right now, to get back to 34%, well, they'd have to double their bond holdings, and that would be a huge boom for the bond market and drive rates across the curve likely back to zero. But the big indicator, if you want to know the one thing that will tell you your bear market bottom, when people start talking about stocks. I'm your host, Steve Van Metre. Thanks for joining me. Thanks for being fans. Bye now.